Hey everybody, I'm Lincoln Wood. Welcome back to Dividend Investing with Lincoln. Now, for those of you who are new here, I'm a business school professor and I spend much of my time exploring how we can generate steady, reliable income from our investments without taking on unnecessary risks. Now, today I want to talk to you about something that doesn't always get the spotlight it deserves. I'm talking about closed-end funds or CEFs. Now, unlike traditional mutual funds, CEFs trade more like stocks. There's a fixed number of shares listed on the exchange. The structure means that their market prices can drift above or below the actual value of the underlying holdings or the net asset values, the NAV. Now, while that may sound complicated, this price to value gap can actually become a real opportunity for us as income focused investors to generate additional alpha. Now, CEFs often employ a combination of other strategies like using leverage or focusing on a niche asset class to generate higher distributions. And this can make them very attractive for many dividend investors who want that steady stream of dividends. So, look, in other words, closed-end funds are particularly appealing if you are seeking diversified exposure to higher yielding investments, but you don't want to spend your entire day juggling complex bond portfolios or ladders, equity income, looking for other alternative assets. CEFs bring it all together in one neat package for you. Now, in this video, I want to get into one specific closed-end fund, EIC. We're going to look under the hood at what this fund invests in, how it seeks to produce steady income, and what you need to consider before you buy into it. Now, by the end of the video, I want you to have a very good idea of whether or not EIC is going to be a good fit for your own portfolio and strategy, particularly if you are the type of investor who values consistent income and who wants a professionally managed vehicle and isn't shy about exploring those lesser known corners of the investment world. Okay, now this is one of my family's largest sort of individual sort of stock holdings, and I've been adding to this reasonably aggressively over the last quarter because I've thought that it's, been reasonably good value while providing a strong source of income. Let's start with the big quarter. Now, they have recently released their quarter three earnings, and in my opinion, those numbers were looking pretty solid. Interest rates, yes, they're coming down, and this is potentially a positive catalyst for a closed-end fund like EIC. So, EIC's goal is to create a high level of current income by investing in collateralized loan obligations, or CLOs. Both on debt and equity side. I'm going to get into that in a little bit more detail later, so do not panic. Hey, there's also a secondary objective, a capital appreciation, but look, let's be honest, this is a fund that's genuinely about chasing steady income rather than looking for big price swings. So at the moment, the dividend is sitting at about 14 to 15%. Yes, my friends, that is a very nice payout. And it gives you the opportunity for some pretty significant income with a relatively small upfront investment compared with some other more conventional asset classes, such as stock market equities. Now, these distributions also come in monthly, and I think that's just icing on the cake and a real bonus for people like me who want to build or supplement a steady income stream. Yes, this is quite a large income, and yes, it may raise eyebrows, and yes, it may make you concerned about the sustainability, and I'm going to go over today why I think this is a reasonable investment, and we'll look through some of those recent earnings to confirm the overall dividend coverage. So it's a relatively new fund. It's been around since 2019, and the share price has seen some decline. But if you add back all those dividends, the total return has been about 49%. Now, if this was launched in ordinary times, that's one thing, but this was launched in the turbulent period. And so this is probably a poor baseline on which to judge their overall performance. But if we look ahead, I think that we can assume that EIC is going to maintain the yield while doing a better job to preserve their capital into the future. Now, the strategy itself is pretty straightforward. They invest in CLO debt and equity. Okay, so what are we talking about here? So CLOs, collateralized loan obligations, it's simply a pool or a collection of loans often to companies that don't have an investment grade credit. So companies that otherwise often struggle to borrow money to expand their business. Now, these CLO loans are divided into different tranches based on risk or repayment priority. Now, EIC focuses primarily on the debt portion, with about 3/4 of the portfolio in BB rated CLO debt. It's got a small chunk in slightly better rated debt, but most of the rest of it is CLO equity. Now, CLO equity is riskier, it's at the bottom of the repayment ladder. So it really relies on valuation growth to be supported here. Now, if you think about this tranche as kind of like a waterfall, when money comes in, it pays out the higher level, the more credit-worthy tranches of debt for CLOs, moving down eventually to the BB-rated CLO debt, which EIC holds, and then money left over flows through to the equity tranche. So yes, it's at the bottom of the repayment ladder. Now, that means that a fund like EIC, because it holds some of that CLO debt rather than just equity, there's much more security here than with some other funds which are equity focused only. Okay, so the good news essentially then that the increased risk from holding the CLO equity, it's balanced then by that more senior secured nature of the debt investments that they do hold. So being further up the capital structure for EIC, it means if something goes wrong, these investments have a higher priority in getting repaid. Now, this helps them to protect a good proportion of their overall portfolio. Another thing I like, well, it's massively diversified. It doesn't hold loans to just, 100 different borrowers. Instead, they hold loans, I think, to about 1,400 or 1,500 different borrowers, and the largest borrower accounts for less than 1% of the net assets. So look, this is a really good mix, and if any one company is a borrower and they run into trouble, I don't think it's going to be such a big deal for the fund. Now, in terms of the industry, their larger exposure is technology, software and services at around 12%, media 6%, healthcare just under 6%. So they've got a good range of industries here, and that helps to insulate the portfolio from sector-specific downturns. Okay, let's get into the Q3 earnings. Hey there, let's take a quick break. If you want more than these few YouTube videos, I would like to invite you today to sign up for my new newsletter, the Dividend Dynamo. Now, in the newsletter, you are going to get some more deep dives. You'll get a heads up on the videos as they're released on YouTube. You'll get insider information not available elsewhere, as well as some portfolio changes that I'm making. All of this delivered straight to your inbox. If you're interested, use the link down below or use the QR code, and I'll see you soon. So, is the dividend secure? Is it safe? So for the quarter, the total net investment income and realised gains came in at 57 cents per share. That was actually substantially increased from the 44 cents per share in the previous quarter. Now, if we drop out those capital gains and we just focus on the pure net investment income, that was 49 cents per share. Now, the dividend of 20 cents per share, that means it's up to 60 cents of distributions per quarter. Well, hey, hang on a second. That does look tight here, doesn't it? So at first glance, that doesn't look so good. But the actual overall portfolio generated a total of 76 cents per share in recurring cash distributions. And this provides a very, very nice cushion. And this coverage then actually not only supports the current dividend, but it's also given the management enough confidence to actually then declare their distributions all the way through into March 2025. Okay, now if we look back in history, we can see the dividend was punched down in 2020 when the pandemic just roiled the market and created so much uncertainty. But if we look at what's going on, EIC's distribution is supported by the recurring cash flows. Their investments are benefiting from higher interest rates, and there's really no immediate reason, I think, to worry too much about a cut. Also, if you look at their dividends, they're considered ordinary income for tax purposes in the US, which may not be as tax-friendly as some of the qualified dividends of other investments. This is something to think about if you are American and you have the option to hold the EIC stock in a tax-advantaged account. Now, in terms of their overall long-term growth, EIC has been investing in its portfolio. So the fund deployed $90 million into CLO debt and equity investments during the quarter. Now, the cash in hand has decreased from $10.6 million in quarter two to only $3 million in quarter three, and the capital deployment suggests that they're still actively seeking for ways to strengthen their portfolio and to expand income streams. Now, the biggest risk here long term is really getting into EIC's default exposure. Recall what they do. They make or buy and invest in loans or collections or pools of loans to non-investment grade companies. So yes, default is a real thing here, but the good news is defaults have been low. The trailing 12-month default rates are below historical averages. Their direct exposure to defaults is only about 0.6% as of September the 30th. Look, there's no major debt maturities for this company until 27 and 28, and so I think that they've got a fairly clear earnings runway for several years yet. Now, CLO default exposure is a bigger topic that I will get into in a later video. Yes, we do have interest rate cuts as well. Yes, that's going to be great if you're borrowing money for your home loan. But yes, it's also going to reduce the interest income that EIC earns. Most loans in these CLOs are floating rate. Now, the lower rates by the Fed mean that borrowers pay less. EIC therefore collects less. But the lower rates also mean that companies have cheaper or lower borrowing costs, and that could actually improve their financial health and reduce the overall default risks. Nice. So if management continues to actively invest, the new opportunities should offset the lower interest income and potentially boost the net asset value over time. Okay, so what's going on? Look, EIC trades at about 7.5% premium to the net asset value. It's a little bit higher than the average 3-year, but the overall robust dividend coverage, the quality of the underlying portfolio, their ability to navigate some of the toughest markets we've seen in a while post-COVID, given all of this, I think a modest premium seems justifiable. So, I mean, historically, some of their premiums have been even higher than they are today. So, today's levels, I see that they represent a reasonable entry point. Now, looking further ahead in 2025, if the Fed continues to cut rates in order to try and increase economic activity and cool down unemployment concerns, and the conditions, they might become more favourable for borrowers in EIC's portfolio. Now that, though, I think could lead to more stability and more growth prospects down the line. Look, nobody can guarantee price appreciation, but the combination of a robust, well-covered dividend and diversified, actively managed portfolios makes a strong case for holding this fund as an income-focused investment. So look, all in all, quarter three earnings, to me, it reinforces the idea that EIC remains on solid ground. It's got a well-covered dividend, a track record of stable to growing payouts, and a diversified set of credit exposures. To me, EIC looks like a pretty solid option for people seeking to prioritise income generation. And as I said, I've been adding to this position over the last quarter, so you can clearly tell that in my view, for me and my family at least, at these levels, it remains a buy. What do you think? Let me know in the comments down below. Is this on your radar? And what would it take to get you buying?